So, questions, reflections on this? Yeah.
One observation during the autumn is that the mortgage rates, particularly adjustable mortgage rate, has going up more than the repo rate and the repo rate expectation. Have you taken that into account in your calculation, or is that something you expect to continue or not?
Well, in the sense that already 2007 we concluded that the interest rate margin is kind of below what one would consider to be something normal, and that the spreads probably should go up. Now they have gone up, but of course it's very difficult to sort of pass judgment on what an equilibrium spread would look like. But it's not all that surprising that what is happening now. But then to say that there is an exact number kind of translating into the repo rate path, that's very, very hard to do. So what we can do is to sort of pass judgment on the whole thing in broad terms. And also, if you look at kind of households' expectations when it comes to the repo rate and what households sort of think about future variable mortgage rates, they are kind of quite reasonably kind of in line with our interest rate path, and that's comforting for us. Yeah.
I have a question about the consistency between different forecasts from you, and I have a table here which I'm referring to now. If I compare the forecast that Riksbank made on GDP, inflation, the krona, unemployment, etc., in February, and compare it to the one today, the picture is that you have raised the GDP forecast considerably, of course, for 2010 by 3 percentage points. 1% for next year, slightly lower in 2012. It's a mirroring picture for unemployment, of course. It's 1 percentage point lower for 2010, 2 percentage points lower for both 2011 and 12. The krona is 2% stronger in 2010, 5% stronger for the next couple of years, and the story goes on like this. So basically what it says is that since the beginning of this year, the macro forecast is much stronger on almost all points. Inflation is just, moderately higher, but still the repo rate path is lower compared to the February forecast. How as an analyst, should you understand this? It's becoming a bit weird, to say the least, that you can have all these fundamental macro variables moving on in one direction and still see the repo rate path actually being shaved down. How can you explain that for me?
Because it's not as simple as that, so that you just can do the mechanics from 1 month to the next, particularly not given the volatility that we have seen in the global economy over the past few years, and the very large swings that we have had to deal with, both in terms of varying growth numbers and all sorts of other things moving around, and the world has changed quite considerably over this time, and that means that it's not possible to sort of just mechanically look at what's going on.
I guess also when we do a new forecast 6 times per year, and when you do that, you of course take into account new information that has arrived, but you also allow yourself to do adjustments on the forecast that are not consistent in your sense, but you might have rethought previous judgments, or you might think that I prefer this now better for some reason. So I think it's kind of difficult, or it's probably not even fair to demand complete consistency when you go back and compare that way. And I just noted that one variable I think that you forgot in your list, which I think does explain at least a portion of it, is the foreign interest rate. That has been revised down, I think, a couple of times. And that, I think, is at least one mechanism that also would affect the Swedish interest rate downwards, everything else being equal.
Possibly via the krona, but since the krona is stronger in this comparison at least. But this is my point. I think that the communication is very tricky because, I mean, the simple conclusion from looking at what you think at one meeting and looking at different macroeconomic developments and trying to deduct a conclusion to the next is really hard. It's been really hard over this year, at least, and in particular over the past couple of meetings, I think. Although we can, of course, I mean, understand what you are going to do, still there is a very strong, I think it is a very strong lack of consistency here.
I mean, you should look at this in on your own forecast as well. And
don't you have to be able to look at what you decided at one occasion, and then there should be some kind of connection to what you decide at the next?
I was just trying to explain. I mean, you should look at this on your own forecast as well and see whether you fulfill your own requirements of consistency. I doubt it. And I mean, as I said, I mean, you try to do the best forecast you can at each occasion. And I think this is the name of the game. It has always been that way. And then we do, you know, evaluations of our forecast each year, how we have been performed with the other forecasters and vis-a-vis the outcome. And if it turns out that we've been doing not so well this year, it remains to be seen.
But shouldn't there at least be an explanation why these shifts have been made? Because it's not always that simple to see why the changes has occurred.
I think you can. I gave you one example. If you put in foreign interest rate in your analysis, I think that would make it easier for you to understand it in the way you did. I mean, you were looking at three variables, and we don't have a system where we say there's full consistency demanded between these three variables. I mean, that's not the way it works.
So the explanation here is
it was just one example. It was just one example, but I think you would have to look at a broader set of variables to understand the full picture. And as I said also, I mean, I think it's a good way of allowing yourself to rethink previous judgments, although it might not be explainable in terms of, you know, that you have revised some other variable or got some piece of new information.
Let me stress that there's nothing mysterious about this at all.
And we are always available, and people can always ask. And we're very transparent when it comes to what we do and how we do these things and how the models work and all the rest of it. And in the end, during this period, it's not different compared to other periods because, as always, it's a combination of modeling and judgment. And that's how this business works, and that's what we do.
The reason why I'm asking is that I got the feeling that there is a difference compared to before.
No, I wouldn't say so. I wouldn't say so. No, absolutely not in terms of how the decision-making process is organized and how we actually go about doing, if I call it doing the work and doing the technical work. I mean, this is a sort of a cyclical thing because we decide once every 2 months. And during this phase, the cyclical aspect of, if I call it, going through all the motions and doing all the technical work has been exactly the same as before. The hard part, of course, given what we have had to go through in the past few years, if you're sort of thinking about it in a sort of a modeling sense, and if you have built into the models behavioral equations based on kind of, let me call it the great moderation, because that's basically what the models pick up, because things evolved in a quite different way in the early 2000s. Then, of course, that means that in some cases the reality is going to kind of take you outside the realm of what the models can handle, and then you have to pass judgment and still get on with it. And that's what we have done, and at least in my view, and I'm part of the process, I can assure you that in a technical sense, we have gone through the technical work and all the various steps in exactly the same way as we've done for the past 5 years that I've been involved in this.
I have a question on your view on the neutral or appropriate repo rate when the output gaps are closed. If we take your forecast, or let's say an average, that we're closing the gaps in 1 year's time, and the repo rate at this time will not be neutral, it will still be below neutral. What is the reason that we can, or you can afford to have still stimulative policy when the output gap is closed? Is it based on also that these gaps are flattening out, or that you can have a slowing economy that's not posing the risk? If you understand my question.
Good question. Now, over time, technically, the technical assumption is to assume that if you just let the models kind of run with it, it goes to around 4%. And then the issue then becomes within what time frame, and how would one go about then doing that, and how does the economy behave, and how does what's this kind of evolutionary process looking like, given that we're coming from this episode with very negative growth numbers for a while, and this is what we have come up with in terms of at what pace do you take the economy back to something that one would consider normal, and what kind of ultimately what kind of a real rate would you like to see towards the end of the period?
Can I maybe also say, I mean, I think if you go back half a year or a year and you do exactly the same exercise you're telling me now, I mean, it would be the other way around. You would according to these gap estimates, you would expect the interest rate to be below neutral for much longer time. So, I mean, that to me is a message of be careful with these gaps. I mean, they change a lot. If you get new information, you reestimate the whole history of these gaps. So I don't think it's a good idea to link them too tightly to the policy rate. I mean, we've been trying to look at these issues in a broader sense. For example, integrating information from the National Institute of Economic Research into these to get a better understanding or a broader understanding of resource utilization.
I mean, it's a bit similar to the whole issue of, it's the other side of the coin, the level of GDP. And when we reflect on it, we just take note of the fact that the level is back to where it used to be 1 year sooner than we expected, compared to if we look at how long we expected in the past this would take for us to get back. And this really kind of reflects that we've gone through an episode which has not been normal. And then one has to pass judgment on the speed with which you sort of take the whole economy back to something that we would like to call normal.
Are you starting to focus on interest rate differentials again? Is that, I guess it's been something that's been discussed at your meeting, that it will affect the strength of the currency, and how that plays out in the way that you set the repo rate forecast?
Well, in the sense that given the economic developments in this country, there is a need to conduct monetary policy in such a way that our policy rate is not going to be what it is in the Eurozone and in the U.S. Then, and that of course then raises the whole issue of, that we haven't had to discuss this at length for many years in the past, because it hasn't been much of an issue, since rates have pretty much moved in parallel. But given where we are, it's an issue worth reflecting on. But on the other hand, those of us who have been in this business for many years do know that in terms of doing exchange rate projections that one would argue could kind of depend on the interest rate differential, it's pretty hard to do, since it's not a one-to-one relationship between the interest rate differential and the exchange rate. So kind of in a theoretically perfect world, it is certainly an issue, and it's also an issue in terms of how you do the modeling and interest rate parity and all the rest of it. But reality is such that the exchange rate moves for many different reasons, and we have said since the krona started to float in the early 90s, that the exchange rate would appreciate. And many, many times we've said so, and it went the other direction. This time, when it comes to the exchange rate forecast, it's a very traditional forecast that we usually do, basically saying that we think that the krona is going to appreciate slightly.